Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to Better System Trader, episode number 126. Thanks for joining us today for this week's trading thought. Now, this one is only going to be a very short one today, but it's a very important one. And it seems from the emails I've been getting lately that more and more traders are becoming concerned about the state of the markets, or especially the stock market, which is understandable. And the concern is really around what's going to happen when the stock markets start falling. Now, they're wondering what could happen to their strategies and their accounts, and how can traders prepare for it now? How can they, what steps can they take to protect their portfolios? Now, one form of protection that often comes up is using diversification to reduce portfolio risk. However, a common question that is raised about diversification is how to actually go about it. Like, is there more value or more protection, I should say, in diversifying across markets, or staying in the same market and diversifying across strategies? Now, in this short piece of audio I'm about to share, Perry Kaufman discusses how he looks at diversification, and it's something that you may want to consider when you're thinking about how to protect your own trading accounts and portfolios in the months ahead. So let's head over to Perry now and hear his thoughts on diversification.
I think it's pretty obvious. It may not be to newer traders, but we learn as we experience more and more markets. And of course, 2008 was an eye-opener for almost everybody. I mean, we've had dumps in the market. 1987, the stock market took a pretty big hit, but by the end of the year, it had recovered. 2008 was not that way. People really did panic. And when you panic, you take your money out of the market. At least that's the way I see it. And that comes to my phrase in the book that says money moves the market. It doesn't matter whether the trend was up or down. When money comes out, whatever trend was up goes down, whatever trend was down goes up. And so whatever positions we're holding are going to go the other way, and has nothing to do with whether General Electric is a better choice than Apple. People take their money out. The market all moves the same way. There's no such thing as diversification by buying individual stocks. Now, of course, somebody will come up with an exception. Things that related to bonds went the other way. But just remember, the market, the quants said that all correlations went to 1. Meaning everything moved together, which could be positive, could be negative, but they all moved together in a related way. So how do you avoid that? You need to offset a long-term trend strategy, for example, with a short-term pairs trading or arbitrage, or a seasonal program, or something that has nothing to do with trends, so that when money comes out of the market, it doesn't affect your positions in the same way. If you're in an arbitrage or a market neutral program and two stocks both collapse, being long one and short the other is clearly going to be neutral or close to neutral. And so that particular system won't be affected in the same way as a system that has a trend position or a net long or short position. So you're looking for systems that really will perform differently in a crisis. And they could be, for example, even a simple sector rotation program will move out of stocks and into bonds. And bonds will react differently. So that's another possibility. So I'm just saying that you need to think carefully about about what systems will not react in the same way. And of course, the only other way you have if you only have one system, then you must deleverage. And of course, finding the criteria, timing that deleveraging is not easy. But the only other choice to not having diversified systems is to reduce your exposure in the market.
Okay, thanks to Perry for that. If you'd like to hear more from Perry, head on over to episode number 46 and take a listen. Now I'll be catching you again in a few days' time where we'll be sharing the first episode of a 2-part special on a particular trading style that is very popular, and we're really going to deep dive into this trading style, and I have no doubts that you'll get loads of ideas from this 2-part series. So look out for that first one in a few days' time and enjoy the rest of your week. Okay, well that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.